Hello everyone. This is Lucas from the Early Retirement Club again. This is an interesting time for investors, with so many uncertainties ahead, such as the current inflationary environments. The market valuation is at a record high and causes considerable valuation risks. Holding some cash is a simple and effective approach to fight such uncertainties. The key question is how much? At uncertain times like this, let's first hear from Mr. Warren Buffett and see what we can learn from his wisdom about his take on cash.
Fair enough. You have over $100 billion of cash.
Berkshire does that.
Berkshire.
Yeah.
No, well, I'm going to see how much you got. Maybe you do. Berkshire has over $100 billion in cash, and you say that you always want this company to be a fortress. So how much cash should an ordinary investor have on a percentage basis, do you think?
It depends on their personal situation. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that. But if your house is paid off, if you don't have big living expenses, you got a portfolio of decent diversified businesses, you don't really need any cash.
So you can be more cash-free than Berkshire is?
Yeah, I've got responsibility. We've got insurance claims. We could have hurricanes that, would happen. All kinds of things where we might have to pay out billions of dollars. And I've got over 1 million people that own shares that are counting on me to run the place so we get through periods like that. But if I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children were grown, the house was paid off and everything. But, I wouldn't worry too much about having a lot of cash around.
So to sum up, the key takeaways from Mr. Buffett's wisdom are: first, how much cash we should have depends on our personal situations. Second, if you don't have big living expenses and you got a portfolio of decent diversified businesses, you do not need any cash. And this is the key topic of today. We will show you a method that we use ourselves to manage cash reserved and meet our short-term needs. It is not a paper portfolio for theoretical discussion. It is a real portfolio that we have been using it for years ourselves to build up our retirement. Third, you can be more cash-free than Berkshire is. Indeed, we will show you that if you manage your cash properly and diversify enough, you can indeed be more cash-free than Berkshire is. Lastly, Mr. Buffett also said that if you have a $1 million portfolio stocks paying $30,000 a year in dividends and no big expenses, you do not need to worry about having a lot of cash around. This will be future topic. We will show you in future videos how to build such a $1 million portfolio and get at least $30,000 of reliable income from it, year in and year out. Every investor was told to evaluate their risk profile, and then to build a retirement portfolio that fits your risk profile by diversification. However, whatever your risk level is, it is a big risk in itself. A key lesson that Mr. Buffett just taught us that at any stage in life, you need to separate your risks and needs. Our method is to separate the risks into short-term and long-term, and then build a portfolio to meet each of these needs. Short-term needs are like the hurricane claims next year or house mortgage due next month that Buffett mentioned. And long-term needs are long-term financial well-being, like the Coca-Cola stock that Buffett has been holding for 40 years. These are the investments that will take care of in case you live to 120 years old. This is diversification at a grand level. It is diversification at a life scale before you diversify at finer scales such as holding different stocks, bonds, et al. And next step, we will see how to build these two portfolios. This is our conservative portfolio to meet our short-term needs. It is a variation of Ray Dalio's all-weather portfolio. I have developed it solve our short-term survival problem. And it did its job. It helped us avoid disastrous crashes and accomplished capital preservation wonderfully through the years. It is not a paper portfolio for theoretical discussion. We have been using it for years ourselves, and a major part of our family funds are invested in it. The portfolio consists of a mix of cash, bonds, gold, and stocks. And today, since the topic of today is cash reserve, we will focus on the cash or cash equivalent and also the intermediate term Treasury bonds. As seen, we hold about 10% cash or cash equivalent in this portfolio and about 15% intermediate bond. We adjust their weights dynamically, and will post updates when we do. However, the guideline is that they should be sufficient to cover at least 6 months of living expenses together with the dividends that we receive from this portfolio. For the 10% cash position, we hold both cash and cash equivalent, such as short-term bond. And one of our current core bond holding is VTIP, the Vanguard Short-Term Inflation Protected Securities ETF. A quick introduction to TIPS. It stands for Treasury Inflation Protected Securities. These securities invest in U.S. Treasury inflation-protected securities with remaining maturities of less than 5 years. That is what makes them short-term, so that their prices do not fluctuate too much with respect to interest rate fluctuations. These securities helps investors with inflation protection and income consistent with short-term U.S. Treasury inflation-protected securities, because their principal and interest are both adjusted for inflation. Particularly for TIPS, as seen, it currently provides an average coupon rate of 0.41%, and it has an average maturity of only 2.6 years. Making it ideal to serve as a cash fund, with inflation protection, and also with a bit of coupon income. So how does it really work? The short answer is it works great. This chart shows the normalized price of TIPS since its inception. In blue. The orange line shows the cumulative inflations during that same period of time. As seen, TIP delivered a total return of 15% since 2013, or 1.56% per year. And as you can see, the inflation is also 15% in total. Sun in the long term, say longer than about 10 years or so, TIP hedges against inflation very effectively. The cash or cash equivalent fund is our first line of defense in the short term. They provide the liquidity and cushion fund whenever we need it. The next line of defense is intermediate treasury bond. These are not really cash anymore, as to be explained later. But their price fluctuations are very low, so they can be considered cash approximate. And our core holding of intermediate bond is VGIT, the Vanguard Intermediate Term Treasury Etf. This ETF seeks to track the performance of the Bloomberg U.S. Treasury 3 to 10-year bond index. It follows a passively managed, index sampling approach. It provides current income with high credit quality, the credit of the U.S. government and some of its agencies. Particularly for VGIT, as seen, it currently provides an average coupon rate of 1.56%, a lot higher than FIPS. And it has an average maturity of only 5.4 years. Now its duration is longer, and therefore it is more sensitive to interest rate changes, as seen next. A bit of Bond 101 in case you are not familiar with bonds. First, the price of bond goes up when its yield goes down, and vice versa, as you can see from this chart. By how much? The duration is a quick, but reasonably accurate, way of estimating the price change. When the yield rises by 1%, for example caused by a 1% interest rate hike, the price of a bond decreases approximately by its effective duration in percentages. So in the example of VGIT, its price will drop by about 5.4%. It is a risk. But it is a small one. Especially if you consider that you are receiving about 1.5% coupon payments per year, which will cancel out a large part of the price fluctuation even if the interest rate indeed goes in the direction against you. After going over the holdings at component level, let's see how the portfolio works at system level. This chart shows the performance of the conservative model portfolio over a longer period of time. The performance of the conservative portfolio is shown by the blue line since 1994. And the performance of the overall market, the S&P 500 index, is shown by the red line. Overall, as you can see, the method does an excellent job preserving capital. And at the same time, the conservative portfolio also kept handsome growth, although the growth lags the overall market in general. For one thing, the sizable cash holding creates a drag by itself. But remember, growth is not the goal of this portfolio to start with. Its goals is to not fluctuates too much. So it provides the cushion funds we need whenever we need it. As seen, it indeed fluctuated a lot less and does a much better job preserving capital than the overall market, especially during market corrections like those in 2008. And here we zoom in one such dramatic market corrections. In the past 3 decades or so since 1994, there have been 4 major market crises. As highlighted in the orange box, the overall U.S. market suffered drawdowns of 50%, 44%, 15%, and 5% respectively. In contrast, the conservative portfolio only suffered one double-digit drawdown of 26%. And all the other drawdowns are in the single-digit range, from 2% to 8%. So the capital preservation capabilities are even more impressive during all the market crises. So again, the conservative portfolio does what it is supposed to do. It provides the cushion funds we need whenever we need it, so that we do not have to sell our assets at fire sale prices when we need funds. This video is getting a bit long. So let's take a very quick look at our other portfolios, the one for the long term. This one is more aggressive, with a focus on growth in the long term. The more long-term portfolio includes more individual stocks we picked for their long-term return potential, such as Apple and Lockheed Martin, and even applies a leverage to the stock holdings. And we are very glad of the performance of our long-term growth portfolio, as you can see from this chart. As you see, our aggressive portfolio outperformed the S&P 500 index most of the time. It really took off and began to dominate the S&P 500 index shortly after the 2008 Great Crash was over. In terms of dollar amounts, the aggressive portfolio outperformed the overall market almost by more than 200% in the past 15 years. For $10,000 invested in the overall market, it has grown to $30,000, not that bad. However, our aggressive portfolio has growth more than 6-fold, to almost $65,000. Truly impressive. With that, hope you've enjoyed the video, and we will wrap up here. To summarize and recap. First, how much cash you should have depends on your personal situations. Second, but regardless of your situations, build 2 portfolios. One for short-term needs and one for long-term. It is diversification at a life scale. Third, the rule of thumb for short-term portfolio is that the cash, the intermediate bond, and the dividends received should at least cover 6 months of living expenses. And lastly, with proper diversification and portfolio management, Mr. Buffett is absolute correct, you can be more cash-free than Berkshire is. Thanks so much for watching, and see you next time.